Yeah, well, first of all, I think the pause is going to be here for a while. I think they pause for a reason. They don't really want to hike, but they don't want to say that. So they have to pretend they're ready to hike more, but don't actually hike more. Maybe they're hoping that the inflation numbers really come down so that they have a justification for not hiking more, or maybe the economic numbers weaken, which that's more likely. It's more likely that we see weaker economic numbers, maybe a pickup in unemployment, or a decline in the non-farm payroll reports. The economic data that's coming out, look at all the data that came out today. Unemployment claims very weak, much greater than expected. Philly Fed was worse than expected. The industrial production capacity utilization worse than expected, all negative.
Right.
I mean, we're getting negative number after negative number. So, I mean, this is stagflation.
Yes.
The economy is weak. The only thing that, Powell is pointing to that he claims is strong is the labor market. And I think there, he's missing some clear signs that there's a lot of weakness in the labor market that he doesn't just recognize.
Peter Schiff dives deep into the current economic landscape, shedding light on critical factors that could shape our financial future. He highlights the Federal Reserve's cautious approach towards interest rate hikes, suggesting they may be buying time for various reasons, from impending economic weaknesses to hopes of taming inflation. Schiff unveils the potential catalysts that could shift the tide, from weaker economic data to mounting pressure on the Fed to generate inflation. He discusses the surprising resilience of gold amidst uncertain times, asserting that its eventual surge is inevitable. Schiff paints a vivid picture of a dollar under pressure, stemming from global shifts away from the greenback and soaring deficits. He challenges prevailing notions about the relationship between wages and inflation, asserting that it's inflation driving wages, not the other way around. With a keen eye on the horizon, Schiff's analysis provides viewers with a unique perspective that challenges conventional wisdom, making this a must-watch for anyone seeking a deeper understanding of the complex financial landscape. Let's dive into the rest of the video.
Yeah, in fact, they're not even piling in yet, they're buying. But I think they're going to be picking up the pace once the price of gold really starts to go up. I mean, maybe right now they feel they can go slower, and they're taking advantage of the fact that the price has been relatively stable. It is a bit surprising that it hasn't already moved up given what's going on. I think that's causing some people to kind of doubt that it's ever going to move up, because they'll say, well, if it can't move up given the circumstances, it'll never move up. Well, that's just not true. It's just taking time. Remember, I think the big headwind that gold has faced, one was the strong dollar, and the dollar is surrendering that strength now. It hasn't broken down yet. I believe it soon will. It's having a very weak day today. But also, the markets still believe the Fed. They still believe Powell when he says he's committed to doing whatever it takes to bring inflation down to 2%, no matter how high rates have to go, no matter how long they have to stay there. And that has been a headwind for gold. But what's optimistic is that even with the expectation of this higher for longer, gold has not gone down. It hasn't gone up. Yeah. It hasn't sold off either. It's kind of holding its own. But I think eventually the markets are going to realize that this is all bluff, that Powell really doesn't have the cojones to fight inflation when that fight causes severe collateral damage to the economy, to the banking system. I mean, in his Q&A yesterday, he said that he's never going to tell Congress to stop spending or stop the deficits. He said that's none of his business. Fiscal policy isn't any of his concern. Well, that means he's going to have to monetize all those deficits that he refuses to criticize, which are skyrocketing. Yeah. There's going to be tremendous pressure on the Fed to create inflation, not to fight inflation. And so when the markets realize that the Fed is not going to be victorious in this fight against inflation, it's going to surrender, inflation is going to win, gold is going to go ballistic, so I just, feel that, I'm willing to wait it out because I know how much it's going to go up when it finally moves. And I'd rather own it now and wait than have to scramble to buy it later at a much higher price. Well, no, I think it's going to fall precipitously. I mean, you really have a perfect storm right now of destruction for the dollar because the Fed tightening cycle is coming to an end. And so that's been the tailwind for the dollar. It's now going to be a headwind. I mean, it's going to be weakening the dollar. But you also have this unprecedented movement now around the world to de-dollarize. Countries that were significant buyers of dollars and then U.S. Treasuries are now sellers. China obviously doesn't want our dollars, and it doesn't want to buy new dollars. It wants to get rid of dollars it owns. Same thing, clearly Russia, is not a dollar buyer anymore. Saudi Arabia doesn't appear to want dollars anymore. Brazil, India, you got major exporting countries that have huge dollar surpluses in their trade and large dollar reserves in their holdings that want to unload. So this is going to put tremendous pressure on the dollar at a time where our budget deficits and our trade deficits are in record territory. We've got $1 trillion a year trade deficits, $2 trillion a year budget deficits. There's no place for those $3 trillion to go, so this is massive inflation because, for years and years, America exported its inflation. We printed money and sent it out to places like China. They used the money to buy treasuries, which kept our rates low. And then they shipped us goods that they produced, which kept consumer prices low. Right. Now we're going to import that inflation back because now the Chinese aren't going to want to buy these dollars. And so therefore Chinese goods are going to be more expensive. We're not going to buy as much stuff. So our prices are going to go up. And now the Chinese are going to take those dollars that they used to hold in treasuries and they're going to come shopping in America to buy our stuff. And a lot of it isn't going to be the new stuff that we make, but it's going to be the old stuff that we already own. So it's like a giant repossession. But all this money is going to come in and prices are going to go ballistic. Well, one thing he just needs is some bigger problem in the banking sector, bigger problem in commercial real estate, some cracks in the labor market. That might give him the cover to say, oh, wait a minute, these conditions are now setting the stage for a decline in inflation. Even if we haven't seen that decline yet, he still has this Keynesian view that inflation is a byproduct of economic growth and employment. So if the Fed has a less optimistic view on the economy and realizes that the labor market is cooling, then, based on that view, the Fed would be justified in saying, look, we're just going to hold our fire for a while because, we think inflation may start coming down. Now, that's not true. Inflation's got nothing to do with those things. In fact, if anything, it's the reverse. The Fed creates inflation when it prints money, and it printed a whole lot of money over the last decade or so. And that's why we're seeing prices going up.
The more significant issue here is not just that all this additional consumer credit and debt is indicative of a weak economy. It's also indicative that the Fed is losing its battle against inflation because the Fed has to rein in credit. The Fed has to raise interest rates in order to restrict credit. That's the purpose of these rate hikes. Again, what the Fed needs to do is discourage people from spending and encourage people to save. That's the purpose of these rising interest rates. But that's not happening. The Fed is raising interest rates, but consumers don't care. They're just borrowing more money and spending more money. So this credit supply is expanding, and that's going to continue to put upward pressure on prices. The Fed is making no real headway in its battle against inflation. All that we've seen is a temporary correction in commodity prices, a downturn in house prices, but beneath the surface, the inflationary forces are as strong as ever. In fact, they're getting stronger. And so all these people who are expecting a meaningful reduction in the inflation rate in 2023 aren't going to get what they expect. After a brief downturn in the official numbers, we're going to see a surge as consumers continue to spend borrowed money, but more importantly, as the dollar tanks, putting huge upward pressure, not only on commodities, causing a reversal and a run to new highs, but on the record level of imports, because everything America buys, and of course, most of the stuff, the merchandise that we buy is made abroad, all that stuff is going to get a lot more expensive as the dollar falls. And the other reason, of course, that people think that inflation may come down in 2023 is they think the unemployment rate will go up, and they expect a rise in unemployment to bring down inflation. In fact, many people still think that's the Fed's goal, that the Fed's plan is to fight inflation by fighting employment. by causing an increase in unemployment, by causing a slowdown at the rate at which wages are rising. People think that rising wages cause inflation, and so the Fed needs to slow down wage growth with its rate hikes. But rising wages don't cause inflation. In fact, looking at wages going up and concluding that's the reason for inflation is like somebody who's sick and they have a fever, and so they take their temperature with a thermometer, and then the thermometer says 102, and they blame their fever on the thermometer. Well, it's not the thermometer's fault. It's just reflecting your temperature. Well, that's the same thing with wages. Rising wages aren't causing inflation. Inflation is causing wages to rise. So the wages are simply taking the economy's temperature when it comes to inflation. Now, you can't fight inflation by trying to stop wages from going up. That would be like trying to fight your fever by smashing your thermometer, or maybe lowering the reading by putting the thermometer in a cup of ice water. That's not going to work. If you ignore the underlying illness and just try to cover up the symptoms or deny they're there, then you're going to get sicker. The same thing is going to happen with inflation. If the Fed is thinking that rising wages are the problem and it tries to solve that or cover that up, then the underlying actual problem that is causing wages to go up is going to continue, and that's inflation.